So now we'll do problem 3.2. The question revolves around, there's three questions for 3.2, and they revolve around the issue of Best Care HMO's statement of operations, which is an income statement. And so the first question is, how does this differ from the exhibit in 3.1? Well, the exhibit in 3.1 is actually a clinic. It's Sunnyvale Clinic. So it's a clinic, not an HMO. And the main difference is going to be how the two organizations get their revenue. A clinic will have patient service revenue because it's rendering services to patients, and that's where their revenues will come from. An HMO is an insurance company, and so it gets its revenues from premiums earned. So when you pay your bill to your insurance company, that's how it makes its revenue. So that's the main differences there. Did Best Care spend $367,000 on new fixed assets during the fiscal year 2011? And so that's based on a depreciation in the expense section of $367,000. The answer is no. It did not. Depreciation does not represent a purchase, and it doesn't represent cash, right? We're dealing with organizations that work on an accrual basis, right? Accrual. And so what we're trying to do is capture the revenues and expenses, the real and meaningful things that are actually happening in the organization when they actually happen. So this organization had depreciation expense of $367,000. What that means is, and it's 1,000. So what that means is that they're using an appropriate depreciation methodology. They have estimated that they used up $367,000 worth of economic value from the property, plant, and equipment, called PPE, property, plant, and equipment, during this fiscal year. So what does that mean? Well, maybe, I'll just use a simple idea. Maybe they have a building that when they purchased it was $3 million. Well, building's not a good example. Some other kind of piece of equipment that cost them $3,670,000, right? And let's say it has a 10-year life, and they're using what we call straight line depreciation. And I'm just trying to make this easy to understand and easy on me. Depreciation, which basically means we're going to divide 367 by 10 to give us an annual depreciation amount of $367,000. And what we'll do is we'll buy the machine, let's say, for $3.6 million at time 0. And then at the end of each year thereafter, so at time 1, at the end of year 1, the end of year 2, what we do is we charge our income statement for 1/10 of the purchase price of the equipment to represent the fact that we're using up 1/10 of the value of the equipment, with the assumption of a 10-year life, that at the end of 10 years, the equipment would be worthless, right? So each year we use up 1/10 of the equipment's value, and so we'll charge ourselves in any given year 1/10 of the value. If we charged ourselves the full $3.6 million during the first year, it would grossly distort the fact that we really only used up a little bit of the value of the equipment in the first year, and then gave our following years free use of the equipment, right? So if we charged ourselves $3.6 million on the income statement during the first year, it would make us look like we used a lot more resources than we actually did, and then in the following years, it would hide the fact that we were using resources that are in fact valuable but aren't there. So that's the purpose of depreciation, is it allows us to spread the economic value of our resources over time as we use them in accordance with accrual concepts. And then the third question is explain the provision for bad debt entry. Um, so bad debt entry is in the wrong place in this problem, as I said when I did 3.1. But what bad debt is, again, is an accrual idea. We may not know yet how much of the revenue, so we have revenue of $26 million, in this case, $26.6 million. Some amount of that we've booked that because people said that they would pay that amount. But in some cases, we're not going to have, that money's not actually going to come in. Somebody's going to say they were going to pay it, and then they never send their check, right? And every organization faces that kind of problem. And so bad debt is an estimate. It's called a provision for bad debts. And so it's an estimate, typically a percentage of the amount of revenue we collect that we know historically, 5% of our patients won't pay, or 10%, or whatever it is. We'll have some idea of a historical percent that just doesn't ever wind up getting paid. That becomes our provision for bad debts. We know it's coming, but but hasn't happened yet, right? So we know that some of these bills that we sent out, we're claiming credit for them under accrual basis because we're aligning our revenue with the time that we actually send out the bills and provide the service. But in reality, we don't get paid until later on. And in some cases, we don't get paid at all. So bad debt allowance is a historical percentage, typically, of the amount that we bill out that we don't ultimately get paid. And we won't know that maybe until the next accounting period. And so we put in a wedge, an estimate for how much that will likely be. And that's what that amount is there. So it's a provision, meaning it's our best guess. 2 or 3 years from now, not 2 or 3, a year from now, we'll know what that was, and we'll have written off some of that bad debt at that point. But at this point, we're just doing our best guess. All right. And then what is BenCare's total profit margin? How can it be interpreted? So total profit margin, there's a couple of ways that this can be done, but basically, total profit margin is going to be net income divided by total revenue, which is 1218 divided by 28,613. And let me just grab my calculator. I forgot to do that. So that's 1218 divided by 28,613 would give us 4.3%, 4.26%. So BenCare is making $4.26 in net income for every dollar of revenue that they bring in. That's what profit margin tells us. It's the overall profitability of the organization. We might also be interested in operating income, but we don't have enough information here to separate out our operating ratio from our profit margin. Excuse me, our operating margin from our profit margin. We just don't have enough information in this case. So 4.26% says they're making 4.26% profit, which may or may not be good depending on what kind of organization, how other organizations of similar size do. And so ratios are only meaningful in the context of comparing them to other organizations.